Hey, welcome to the channel. Today I'm going to talk about how I, as an accountant, approach my investment strategy. I think first of all, the best thing to cover is why the market moves in the first place. So the market is basically what people think is going to happen rather than what actually happens. So that's why if a company does something bad in the news, their share price drops all the way to the floor. It's not because they've actually lost any money, it's because people think that it's going to do badly, so they sell all their shares. So once their shares are all on the market, when everyone sells them, they flood the market with the shares, the price drops because it's just supply and demand. Generally, what happens is if a company is doing well, its share price will continue to gradually grow, and also it depends on how the economy itself is doing. So if the economy is growing, then even if the company is producing the same amount of profits every single year, it will gradually go up as the economy is growing. But when the company outgrows the economy, so when it grows faster than the economy, it shows that they're perceived to be performing well. So usually it's pretty accurate. If you perceive it to do well, it probably is doing well because you've looked at the financials and you can see that the profit is going up and there aren't any ethical issues that you see. So, you know, it's not got any lawsuits or anything like that in progress. So it's generally a safe bet and people will start to buy and gradually just keep holding them into their portfolio, and the price will just keep going up. So now we've discussed why the prices move in the way they do. You now are going to want to know how to get your money in there and start making money. There are tons and tons of investment platforms out there. I use Hargreaves Lansdown. There are obviously tons more. You need to do your research, but the bit of advice I'd give you is make sure that you have a look at the charges. So Hargreaves Lansdown do it on a percentage basis. So if I put down a £10 investment, it will take a small percentage rather than a fixed fee. However, I used to bank with Lloyds, and their platform was every single transaction cost you £20 to put on. So if I was putting down a £10 investment, it would make sense to do a £20 investment fee. But on the flip side, if you're doing a £1 million investment, you're not going to want to do a percentage basis because, you know, 0.5% is going to be a lot more than 20 quid. Whereas, you know, a fixed fee of £20 would then benefit you. So do your research, think about what is going to be best for you, and then do that. Once you've decided what platform you want to use, then you need to decide what kind of account you want to have. I do all of mine through an investment ISA. So an ISA is essentially a place where you can keep your money and it doesn't get taxed. So the interest it gets on it from the bank, it doesn't get taxed. If you have a stocks and shares ISA and you put all of your money into the stocks and shares ISA, if you open up a stocks and shares ISA, you're only allowed to put in £20,000 at the time of recording. So this is something that you need to bear in mind when you choose what account you want to have. So the benefits of having an ISA is it's completely tax-free. Any dividends you get paid from your investments aren't taxed, and any share growth you get, you don't have to pay any capital gains tax. You get it, you sell it and you keep the money. So it's a win-win. But on the flip side, a normal investment account, you get taxed on your dividends, you'll get taxed on your growth and all that really fun stuff. But there are no limits. So it then comes down to how much you're actually investing. And then we'll change the angle for strategy. If I change the angle, make it look fancy. So my investment strategy is something called value investing. So that's when you get a stock that essentially you think is undervalued in the market. So the way you'd see this is you would take a company's market capitalization, which you could easily see on your investment platform, and that is essentially the value of all of the shares that are in circulation for the company. So it's essentially what we as potential shareholders value the company. That's how much value we put on their shares. Whereas you can then actually look at their financial statements and check their net assets, which is how much in hard cash the company is actually worth. So a typical undervalued company would have net assets which are bigger than their market capitalization. As investors, we think that this company is worth less than their actual net assets, which is if they sold everything, if they sold all their machines, they sold all their inventory, and they paid off all of their liabilities, their debt and their loans and stuff. This is the money we'd have left over. This is their net assets. That pot of money we think is worth less than, no, that's not right. We think that, so once you've sold everything and got your net assets, which is just the cash left over, that should essentially, in an ideal world, be what the company is worth. That is the pot of money that this X company is worth. But we've heard bad news and we've panic sold all of our shares, so their share price has actually fallen and their market capitalization is now worth less than the company is actually physically worth. And in an ideal world, a company should kind of, in the ebbs and flows of the market, it should be equal to their net assets, really, plus any brand value that's been accumulated. So Facebook, obviously, if they sold all their computers, this is going to come nowhere near how much they're actually worth. That's their reputation, their brand that's adding that. But it's really important to know that on the flip side, if market capitalization is more than their net assets, this is actually normal, and it doesn't necessarily mean that the shares are overvalued. So it's not to say that you shouldn't invest in them, because you can, and quite a lot of people, well, most people do. The thing to watch out for is you need to make sure that when you do look into the financials and you see that they might be overvalued, just take a look at quite a few of the other companies in the same industry, because it may be that it's a normal thing for that industry. So when you're deciding whether something's under or overvalued, don't look at it in isolation, look at it in terms of everything, because the more data you use to make an investment decision, the better off you're going to be in the long run. So now that we've discussed the platform, how the market moves, you now want to start analysing the companies. So the way I do this is I have a subscription service. So there are tons and tons out there, but it is really, really important to know that no one can predict the future, and these companies are just going to be analysing the management team, their performance, the company's performance, the economy and how that's going to affect the company going forward, and then they make suggestions based on that. They don't know what's going to happen, so that's just worth knowing. So I use Motley Fool. Well, it's my dad's, but Motley Fool basically has hidden winners, which are companies that they believe have a lot of growth potential, and they also have Stock Advisor, which is just, stocks that they advise you to have. So I use that to pick out my companies that I want to look into, because they obviously have assessed the management team and can see that they've got a good management team behind them, and they think that it's going to be good going forward. So I use that as a guide, not a rule. So once I've got those companies listed down that the subscription service suggests that I should buy, I then do my research on the financial statements and compare the net assets to the market capitalization, among other things, and that gives me a really good indication as to whether something's undervalued in comparison to the rest of the industry, and go from there. So once you've picked the companies that you want to invest in, you need to be really smart about how you compose your portfolio. So if you do research on 100 shares and you invest in 100 shares and they're all UK businesses and the UK economy crumbles, you're going to be a lot of money down. So it's really important that you diversify your portfolio. You can diversify your portfolio in so many ways. So you can buy stocks, and then you can buy bonds, and you can buy shares in funds. You could also diversify your portfolio by buying stocks in different markets. You can go into the Japanese stock market, you can go to loads and loads of different stock markets, so that if the UK economy crumbles, then you've still got some really good share choices in your portfolio that is going to help mitigate the amount you lose on the UK shares. So typically, if you want to play it really safe, you'd probably want to lean towards the 25 to 15% of your portfolio being shares, and the 80-75% going towards bonds. Now, bonds are really, really stable. There's not really much volatility in them at all. You can also go for government bonds, which are also called gilts, and they're also really, really safe. You won't get much for them, but based on what's going on with savings rates at the moment, it's definitely a much better choice than putting it in a savings account. If you want to take a bit more of a risk, try and get more reward, then you can move your portfolio towards more of the 50-50. You can also think about funds as well. My philosophy is, why would I want to invest 100% of my money and not be able to do as much research as these funds who've got massive teams doing research? I would rather give 1% of my investment to those guys and it be professionally managed. So I personally have 15% of my portfolio in stocks, and I have 85% of my portfolio in 3 funds, 2 of which are split fairly evenly between the US and the UK market, and 1 is mainly on the UK market because I feel that the market's going to rebound, and buying around about now when people are still a bit skittish, and then when people get confidence they'll buy shares and the shares will go up and you make money. So my philosophy behind choosing funds is really quite simple. I just do research on their performance. So some have made loads and they've lost loads, and they've made loads and lost loads, and that's not where I really want to be, because I'll have a heart attack every time it falls through the floor. I want big defensive funds that know what they're doing. One of the ones I'm in has shares in PayPal, Microsoft, Apple, Amazon. Although it is heavily US, it is very defensive because the way we're going, everything's going online, so the likes of PayPal, they're not going to do too badly. Amazon, not going to do too badly, that sort of thing. I'll be honest, I think that pretty much covers it. So hopefully that helps. I've gone over the basics of why the market moves the way it does, how to get access to the investment platforms and markets, how I structure my portfolio, how I do my research. I mean, that's a pretty comprehensive video, to be honest. If you have any questions, just comment. Oh, I'm getting light up through the window. Yeah, thanks.